Welcome to this segment of The Wealthy Life. With us today is John Salisbury, Portfolio Manager at Strong Private Wealth at Raymond James. John, welcome to the show.
Thank you, Sybil. It's a pleasure to be here.
I want to know from you, what are the questions that investors need to know the answers to?
There's 4 very simple questions that ensure the success of any financial relationship.
Just 4?
That's really what it boils down to.
Great, let's hear them.
1, rate of return. Is it a reasonable rate of return? 2, what is the level of risk? Do they understand it? 3, what does it cost to actually run the relationship? And 4, what is the progress towards the client's ultimate goals?
Wow, when you put it that way, it makes things pretty simple.
It actually really is. In the background, we are the ones who have to do all the work. People are coming to us to achieve certain things, and that's our responsibility as professionals.
So number 1, you talked about rate of return expectations. What do you mean by that?
A rate of return is a level of return that is discussed with the client at the outset of the relationship that should be a return that the advisor is confident that he can actually achieve for the client.
So it needs to be realistic rate of return. And what about risk?
Risk is key as well. The level of risk that a client actually is going to experience, or the actual emotional experiences that might occur in a down market, are things that have to be tempered, and you have to work with the client to make sure they understand the emotions that they are going to experience at those times, so that they maintain their long-term approach as opposed to making a poor move.
You know, understanding risk is important so that they don't make bad decisions when the markets get choppy, but it's also making sure people don't go more conservative than they need to be to achieve their goals.
Either more conservative or sometimes more risky.
Yes, either way.
Both ways.
And fees.
Fees are key. Fees, everybody understands that things do cost money. And there are certain levels of fees that we are required to disclose, but there are many levels, levels of embedded fees that are not required to be disclosed. It's very important that these fees are just disclosed up front, discussed up front, so there's nothing that the client has to be searching for or has to dig up. If the client has to read documents to figure out the extra level of fees, it almost erodes the trust in the relationship.
Yeah, and understanding the fees right up front can then move the attention to the results, which is the most important part.
Results. What people have financial plans, those financial plans have to be reviewed frequently. Not every 10 years, but we can look at them every year, every 3 years, 5 years. We want to see, are we on track? Are we on plan? Are we in a surplus? Are we in a deficit? Why?
So have a plan, but make sure you check on it regularly to make sure you're on track to achieve your goals.
Absolutely, just like any other well-run business.
Well, John, that has been so helpful, and I think one of the most important steps in that whole equation is understanding your risk. So contact us for your free risk assessment tool, and that's a good base to ensure you're earning the most you can with what you have. John, thanks for being with us today.
Thank you, Sybil.